at the bond features and pricing, chapter 13. In this chapter, we will look at the finance diamond, bond pricing yields, and we will solve some problems and quick wrap up. As you remember, we look at in the previous chapters, we look at the toolbox, present value, future value formulas, perpetuity, annuity formulas, return formulas, risk measurements, and we explain the transfer, direct and indirect transfer from savers to borrowers, financial institutions and financial markets, and financial statements, 10K, 10Qs, cash flow statements, and other income statement. And we look at the stocks, and now we look at the bonds and bond pricing. So bond pricing, the value of the bond depends on the future cash flows, similar as the stock valuation. Comparable bonds can have different coupons, and comparable bonds can have different prices. And price is the sum of the present value of the coupon payments and the principal repayment. So the price can be calculated by looking at the coupon payments, the present value of coupon payments, and the present value of the principal repayment. So the bonds have face value of 100 or 1,000, but can be traded at par, at a premium, or at a discount. So current price differs from the face value. Okay, so let's solve a question. Find the price, present value of the 1,000 face value bond that pays 6% interest annually and matures after 3 years when the current discount rate is 6%. So we have, let's say, time 0, time 1, time 2, time 3. We have payment 1, payment 2, payment 3. So find that we looking at the present value. We have payment 1, which is 6% interest payment, which means 1,000 multiplied by 6%, which is 60 interest payment. We have 60, 60, 60. At the end of the third year, we also get the 1,000, right? 60 plus 1,000. So we just simply try to find the present value. How can we find this? As you remember from the previous chapter, chapter 11, we calculate the present value of all the payments. So you can do it manually, and also you can use your financial calculators. So go and find the payment button and enter 60. For future value is 1,000 plus 1,000. This is inflow. Number of years is 10. Interest rate is 6%. We're looking at the present value, present value of this. We look at the present value essentially. So you will find minus 1,000, meaning if you pay $1,000 today, this is outflow, you will get $60 yearly payment, and at the end of the third year you will also receive 1,000. So as you see, we have same payment. We're paying 1,000 and we're receiving 1,000. Future value of the bond is 1,000. Present value of the bond is 1,000, and the interest paid 6%, and discount rate is 6%. So quick summary: if the discount rate and the interest rate is the discount rate and the interest rate is equal, we will have same value for inflow and outflow. Okay. Another question is the price value of a bond. The present value of 1,000, the par value bond that pays 6% interest and matures after 3 years when the current discount rate is 8. We need to find the present value of a bond which has the future value of 1000. Okay, same, time 0, time 1, time 2, time 3, and 6% interest, so 60, 60, 60, and 1000. We need to find present value, but now we have discount rate is 8%. The discount rate is 8%. 8%. What is the present value? Similar, we enter 60 annual payments, and future value is 1000. We discount 61 plus 8%, or let me write this way. Payment is 61 over 0.08, 1 plus 61 over 0.082 plus 60 divide over 1, 0.8 over 3 plus 1000 over 1083. So if you sum all these values, we will get the present value of this bond, and we will find minus negative 948.46. So if you pay 948.46, now we'll get $60 interest payments and $1,000 at the end of the third year, 1,000 payment as a principal amount. Okay, let me clean here. So a quick conclusion here, as you remember, we are using 8% discount rate, but the interest rate is 6%. So the discount rate is 8%, is different from the coupon rate, which is 6%. When discount rate is higher, meaning payment 1 plus interest 1, payment 2, 1 plus interest 2 plus payment 3, 1 plus interest 3 plus future value divided by 1 plus interest 3. If the discount rate I is different from the coupon rate, we is higher than if the discount rate is higher than the coupon rate, then the current price of the bond falls below the face value, which means that the bond is selling at the discount. In the previous example, we have same rates, which is the discount rate is 6% and the interest is 6%. We have same amount for present value and future value. We say in this situation the bond sells at par. If the discount rate is higher than the interest rate, that means the bond is selling as discount, because the present value of this bond is less than the future value. Another example, find the present value of the 1000 bond that pays 6% interest, which is after 3 years when the discount rate is 4%. Now discount rate is less than the interest rate, and let's solve this question. Now time 0, time, okay, let me write payment 1, payment 2, 3, future value 1 plus I, 1 plus interest rate, present value, over 1 plus discount rate, sorry, yeah, plus future value over 1 plus interest rate, 3. So we have discount rates, we have this, we have payments, and we just discount these payments and find the present value for each payment. What if we have discount rate is lower than the coupon rate? Then we will find higher present value than the future value. Future value is 1,000. In that case, we say the bond is selling at premium because it's higher. The present value of this bond is higher than the future value. So it's a premium. Why? Because we have 4% interest rate at the denominator, and in the numerator we have 6%, which cause higher higher valuation. What is the relationship between bond prices and interest rates? It's inverse relationship, meaning if the interest rate is increased, the bond prices is decreased, and vice versa. The interest rate risk is if the interest rate increases, bond prices will decline. If interest rate falls, bond prices will rise. How about maturity? When interest rate changes, current bond prices will change. Yes, and but the prices of bond with longer time to maturity will fluctuate more than the price of bonds with the shorter time period. Let's see let's see the difference. So the current interest rate is 12%, but the maturity of the bond is 10 years here and 20 years bonds here. So when you look at the price of the 10-year bond, you will see we have 774, and for 20-year we find 701. If you look at the current interest rate, if you decrease the current interest rate, you will find the price of the bond is increased, but for the longer maturity, for the longer for the bonds with longer maturity, the fluctuation is higher than the shorter time period, than the bond with shorter time period. So exactly, the price of bonds with longer time maturity will fluctuate more than the price of the bonds with shorter time period. As you see, it fluctuates more when we have 20-year bond. It's the difference between 1300 and 700 is higher than the fluctuation between 1200 and 700. It's higher. Okay, so as we know, the bond pricing, the relationship between interest rate and bond prices is inverse, meaning the higher the interest rate, the lower the bond price. And important features of the bond pricing is no matter a bond is currently traded at the discount or premium, the current price, which is the present value of a bond, will approach face value at the time approach maturity. Okay. Basically, we find the present value of the bonds with different coupon rates. It can be 0%, it can be 3%, 5%, or 10%. But at the end of the 30 years, which is the maturity date of the bond, for this example, they will approach their face value. Okay, when the market interest rate is fixed, the bond with higher coupon rate has higher price than the bond with lower coupon rate. Let's solve a problem. You're considering buying a 10-year 1,000 bond with a coupon rate 5% paid annually. Okay, so meaning you have $1,000 par value. We have 1,000 bond with par value is 1,000, and interest rate is 5, meaning $50 per year interest. And at the end of the 10 year, we will receive a 10,000 principal amount. If the discount rate is 5%, what will you be willing to pay for this bond? Okay, if you have the discount rate is equal to interest rate, we know this answer without calculating. It will be exactly 1,000, right? If the coupon rate is exactly the same as discount rate, we are expecting the present value of this bond is 1,000. So I want to pay $1,000 today and expect to have $50 payments each year, and at the end of the 10 year I will receive the $1,000 dollar payment. So this is equivalent to $50 annuity and the 1,000 single sum problem combined. We can also solve it as manual or using calculator. Yes. So okay. So by formula, this is a combination of annuity where we receive $50 once a year for 10 years at 5%, and the single sum where we receive 1,000 10 years from now at 5%. So this is just annuity problem, and if you look at your table, selected ratios and definitions table that I put the table on the blackboard, you will find the present value of an annuity formula, which is the coupon payments over interest rate multiplied by 1 minus 1 over 1 r 1 plus r, the power of n. So you will basically find the present value of the coupon payments for 10 years. And okay, let me find this way. Payment 1, or let me explain this way. Time 0, time 1, time 2, and time 10. Okay, for time 1, we have payment 1. For time 2, we have payment 2. And for time t, we have payment t plus principal. So we try to find the present value of these payments. How can we find this? By using this formula, we find present value of all these payments, but we also have the principal amount, which is 1,000, and we need to discount 1,000 payment in 10 years 2 times 0. How? We just cash flow is 1,000, 1 over 1 plus r, 1 plus interest rate, power of n, which is 1,000 payment. The interest rate is 5, power of 10. The present value of 1,000 is 613.91, and also we need to add up the summation of present value of payments, which is 386.09. If you sum two numbers, you will get 1,000. So without calculating these numbers, we already know the price, the present value of this bond is 1,000, because as I explained, the interest rate and the interest rate is 5% and the discount rate is 5%. It should be 1,000. What if we, as you see, the present value of annuity and present value single sum is 1,000. So what if we have 6%? interest rate rather than 5%. So discount rate is higher than the interest rate. So similar calculation, we need to use the present value of the payments for 10 years, and we will get 368. And then we need to find the present value of the 1,000 principal payment, which is 558. When you add those numbers, and you will get 926.39, which is lower than the par value. So that means the price is less than 1,000, and because the current interest rate is higher than the coupon rate, and the bond is trading at discount rate. Okay. For the second or the third example, when the interest rate is 4%, so you discount the payments by using 4%, and you will get 405 for the discounted present value of payments, and you need to discount principal amount, which is 1,000, discount by 4%, you will get 675. When you add up these numbers, you will get 1,081, which is higher than the par value, which is higher than par value, which is 1,000, and we call it the bond is traded premium. Yes. Let me. Yeah, the bond is selling at premium if the present value is higher than the principal amount. Okay. Okay, when we look at the yields, the current yield is annual interest payment over current price of bond. For example, we have 1,000 future value, 1,000 bond that pays 6% interest and matures after 3 years, when the current discount rate is 8%. Okay, interest is 6% and discount rate is 8%. We have already calculated out that the current price is current price is 948. So we're saying that the bond is selling at a discount. And what is the current yield? How can we calculate the current yield? So we know the coupon is 60 because interest rate is 6%. 1,000 multiplied 6% is 60 interest payment. What is the current price? We need to put the current price in denominator and 60 in numerator to find the current yield. 60 is the interest rate, and then 948 is the present value of the bond. So 6%, 6.33% is the current yield. However, the disadvantage of the current yield is that it doesn't consider any future change in the bond price if the bond is yield to maturity. Okay. So the rate which equates the cash outflow and the present. Okay, we're now looking at the yield to maturity. In order to find the yield to maturity, we are looking at the payments present value, payments 1 over I1 plus payment T over 1 over IT. So we know the present value, we know the payments, and we're just looking at the interest rate that equates two sides. So this is the yield to maturity. So the rate which equates the cash outflow, this is cash outflow. You're paying some amount of money to buy a bond. This is outflow, cash outflow minus should be equal to the present value of the all future cash inflows, coupon payments and principal payment. So let's solve a question. Consider the bond with the current price of 952 and the face value is 1,000. The annual coupon rate is 10% and it matures 3 years. What is the current yield of this bond and what is the yield to maturity? Okay, first we need to find the present value. What is the current price, meaning the present value of this bond? We already know the current price. Present value of this bond is 952, and interest rate is 1,000 multiplied by 10% is the interest payment, coupon payment. So the current yield is 10.5%. How can we find the yield to maturity? If you go if you calculate by using your financial calculator, you enter the present value is negative 952, which is the outflow amount, and you'll enter the payments, interest payments, $100 because the annual coupon rate is 10% and the par value, the face value of the coupon is 1,000. So the payment is every year you will receive $100 payment, and future value is 1,000. Number of years 3. So we compute interest, which is yield to maturity. So you're paying 952 now, and you will receive $100 in 1 year plus interest rate 1. In the second year, you will receive 101 plus interest rate 2, plus third year you will receive 100 payment, 100 interest payment, plus you will receive 1,000 principal 1 plus I 3. Why I'm writing 3 is because you will receive all these payments at the end of the third year. So we basically try to find the interest that equates two sides, which is 12% yield to maturity. So we are saying the yield to maturity is 12%. That equates to two sides of this equation. So if the bond sells at discount, yield to maturity exceeds the current yield. Why? Because if the yield to maturity is higher than the current yield, meaning your denominator is much higher than the numerator, you will get much less amount than the par value. And if you have higher current yield than the maturity, than the yield to maturity, the bond sells at premium. Why? Because the denominator is lower than the numerator, and you will get higher present value than the par value. So current yields and the yields to maturity for 10-year bond with 8% annual coupon. So the price of the bond is 1107. Coupon payments is 8%. Current yield is 7.2 because we just find the, how can we calculate the current yield? We just find the coupon payment over present value of the bond, and we find 7.2. Yield to maturity is the interest rate that equates two sides, which is 6.5 and different than the current yield. So annual coupon rates are stable, 8%, but the current yields are changing depending on the present value of the bond. So for the current yield, we have interest payment in the numerator and the present value of bond in the denominator. And if the present value of the bond decreased, you will get higher current yield. And yield to maturity is basically equates two sides, and the price of bond is lower than 1100, let's say 798, you will have higher yield to maturity that equates two sides. Basically, basically this equation. So the yield to maturity calculation, the current yield does not consider any change in the price if the bond is held to maturity. Yes, and the yield to maturity considers both the flow of interest income and the price change throughout the holding period. And the yield to maturity essentially equates to find the discount rate, and the calculator is your only tool to calculate the yield to maturity. I think this is not readable. Let me write the equation. So we have price. So we have present value, coupon payments multiplied by 1 over y. Y is, we can write it, we can write 1 over I, 1 minus 1 over 1 minus I over n. So this is the NU factor using the yield to maturity. Yield to maturity is I plus future value divided by 1 over I over n, which is the principal amount. We're just discounting principal amount time 0. This is the coupon payments. We just find the present value of the coupon payments. So this part is the present value of all of the periodic coupon payments. This part, the present value of the face value repayment using the yield to maturity. So the yield to maturity calculation basically use this calculation. I don't recommend to calculate manually. Just use your financial calculator, and if you give the coupon payments, if you enter payment, future value, present value, and you're just computing the interest rate, which is yield to maturity. Okay, let's solve a problem. So consider the 5-year. So n is 5, 1,000 bond, the future value is 1,000 with 2.2% yearly coupon rate and semi-annual coupons. If this bond is currently trading for a price of 963.11, what is the bond yield to maturity? Okay, we don't know but we know the coupon payments, but the coupons paid semi-annually, meaning that 1,000 multiplied by 2.2%, which is 22, paid annually, and paid how much interest payment paid in semi-annually is just over 2, which is 11 dollars paid in semi-annually. And okay, let's solve by using a financial calculator. We have the present value, which is 963.11. Okay. Right, and future value is 1,000. And as we have semi-annual payments, we need to multiply by 5, multiply 2, which is 10 payments, and the payment is 1,000 multiplied by 1.1%, because 2.2% is annual payment, 1.1 is the semi-annual payment, so the semi-annual payment is 11. We just try to find the yield to maturity. This calculation is manual, and if you look at the selected ratios and definitions, you will find this formula, and the formula, when you put the values in the formula, like 11 is the periodic payment multiplied by 1 over interest. Y is the interest. Actually, this is the yield to maturity, and 1 minus 1 over 1 plus y power of 10 plus future value of bond 1,000, 1 plus y over 10 should equal to 963.11. So we already know the present value of this bond, and the future principal payment is 1,000. We know the n number of payment periods. We're just looking for y. Y is the yield to maturity. So it's very hard to solve this equation manually. So just go and use your financial calculator. It's super easy. Just enter the present value, which is outflow, should be negative. You're paying 963.11 now, and you will receive $11 semi-annually for 10 periods in 5 years, because it's semi-annual payments, and each payment involves $11, and we just try to find the yield to maturity. It's simple. You compute the yield to maturity 1.5%, but this is semi-annual, so you need to multiply this rate by 2 and find the annual yield to maturity, which is 3%. Problem 4, what is the coupon rate of 10-year 1,000 bond with semi-annual coupons and a current price of 1,004.53 if the yield to maturity is 5.5? Same, we already know the present value, number of period, because semi-annual, 10 years, So we have 20 number of periods. Future value is 1000. Yield to maturity is 5.5 annually. For semi-annually, yield to maturity is 2.75. So we are looking for the payments that we will receive each period, which is 27.8 semi-annual. So if you want to find annual payment, you just multiply by 2, and the payment is 55.6 annual payment. What is the coupon rate? The par value of this bond is 1000, and the coupon payment is 55.6. The coupon rate is 5.56. Okay. Let's look at the relationship between coupon rate and yield to maturity. When the bond price is greater than the face value, which is, in our example, we use face value 1000. So if the bond price is greater than, let's say, 5200, present value of the bond, greater than the par value, usually the par value of the bond is 1000, then we say the bond trades above par or at premium, which makes sense. And this occurs when the coupon rate is linked to the numerator, is higher than the yield to maturity. Yield to maturity links to the denominator. So if this is higher than the denominator, we're expecting a premium. The bond trades at premium, which if the bond price is equal to face value, second case is equal, the bond price is equal to par value. So it occurs when coupon rate, which links to the numerator, equal to yield to maturity, links to denominator, and we say the bond trades at par. Par means the value. This is the bond. We see the par value here, which is the principal amount that we receive in the future. And when the bond price is less than the face value, let's say 500, the present value of the bond, but the par value is 1000. So we say the bond trades below par or at a discount. When this occurs, it occurs when the coupon rate, it links to the numerator, less than the yield to maturity. Yield to maturity links to the denominator. So please read your notes, PowerPoint slides, and Chapter 13, and solve all the exercises from MindTap. All the exercises, quizzes, video reviews, PowerPoint slides, and flashcards. And that's all for today. See you next time.